So I want to cover three things in this video. The first one being how a business is valued, or how we set a price on a business, how to position it for the highest dollar amount. So that's going to be the objective, is just how do we get the highest possible price for the sale of this business. And then lastly, who's going to buy this business? Now, I know there's probably several different types of people watching this from different industries, and so I will touch on that as well. But just to start with the very first one is how do we value a business? And I do want to go a little bit in depth on each of these. Just if you are looking at selling your business now, in a year, in 3 years, or eventually at some point in 5 to 10 years, right? So how we value a business, as you can imagine, everything does revolve around the numbers. It starts with the numbers. It's not all the numbers, but it starts with your financials. And when we run a valuation on our end, I'm a business broker, and so when we bring a business to market, we do a valuation first to get the right price range and price expectations with myself and the business owner before going to market. We run what is called a valuation on the business, and how we do that is we look at the last 3 years of your financials. And so we'll send clients an NDA, so everything is secured under NDA, and then we will request the last 3 years of profit and loss statements, the last 3 years of the tax returns, the last 3 years of the balance sheets. That can help with a lot of situations, and then a year-to-date profit and loss statement, so the current P&L of where we're at in the current year. So once we have those three documents, what we're going to do is we're essentially trying to find this earnings metric. If you've heard it all or done a little bit of research at all, you'll find out pretty quickly that businesses are bought and sold for a multiple of what they earn. And so that's what we first start with, is figuring out that earnings metric. And that metric could be EBITDA, if you've heard of that, which is the business's earnings before it pays interest, taxes, depreciation, and amortization, or SDE, which is seller's discretionary earnings. They're both just, fancy ways of measuring profit. It's not actually profit, but it's essentially your bottom line earnings is what we're looking at. You're typically going to use SDE, seller's discretionary earnings, in more of an owner-operated business, whereas you'll see EBITDA when the owner's a little bit removed and probably not taking a W-2 salary and just taking draws, right? But they both do the same thing. They tell buyers the cash flow within the business so they can compare business to business. So that's what we're trying to figure out. We're trying to figure out that earnings number for the last 3 years. We go back 3 years. Sometimes buyers and sometimes banks like to look at 5 years, but really the rule of thumb and what you should focus on are the last 3 years. And so right there, if you're planning on selling, you can take a look at your financials and say, well, the middle year of those last 3 years was a little down, and it wasn't as good as we could have done. And you are willing to stay in the business for a little bit. You're not looking to sell now. Well, you can start to get a couple more years under your belt to push that middle year out. And so now your previous 3 years are very strong. They're consistent. They're showing growth, right? And so that would be the first thing to keep in mind, is you just want the last 3 years, really ideally at all times, to be growth, growth, growth. And again, this video is going to be about how do we get the highest possible price in the best ideal situation ever. That would be one of the first things I would say, is looking at your last 3 years, that you want them to be your strongest 3 years in the business. So going into figuring out this earnings metric, the tax returns are always going to be the gold standard for business brokers, for buyers, for banks. And I'm sure the first thing you immediately think of is, well, I draw all my profit down for tax purposes. My CPA shows little profit for tax purposes. Totally understand that, see it all the time. And it is fine. And again, if we want to go into an ideal world, you don't want to do that on your tax return. And I know that means you're going to pay more in taxes if you're going to set it for the last 3 years, and you're going to have your tax returns show as high or as much profit as you possibly can in the previous 3 years. You're going to pay more in taxes for those 3 years. But the value, the price tag for your business, it's going to be significantly higher than the amount of taxes that you save on your business. And I'll kind of get into that a little bit as well and explain why. But how we get this earnings metric, so we're going to start with your tax return. And we're basically looking at your net operating income. So that bottom line in your tax return, we're using the profit and loss as well. We're pretty much matching them up or using them both to build up this earnings metric. And so if profit is drawn down, which we see all the time, right? That's nothing to be concerned of at the moment. But we're going to look at that net operating income, that bottom line, and we're going to start building that profit back up. And what I mean by that is we're going to add interest to that net operating income. We're going to add, so this is the EBITDA, so we're going to add the interest back, so like a bank loan or any debt like that. Taxes, if that applies to your business or your estate. And then depreciation and amortization. We're going to add all of those categories back to that net operating income or the profit of your net profit of your business. And that's going to give us your business's EBITDA, right? And the reason why we add those back and when we don't deduct them for this earnings metric is because buyers are going to be structuring the business differently. They're going to have different debt on the business. They're going to have different depreciation schedules. They might have different tax strategies, or their entity might be different than yours. And so we do this because we want to show buyers what the cash flow of the business is if they're looking at other businesses, so they can really compare business to business, and they can extrapolate things like taxes, things like depreciation schedule that I just touched on, right? So that's a very common practice, and that's how we get EBITDA. But then we go a step further and we use adjusted EBITDA. And the reason why we do this is because there could be one-off expenses in the business that aren't normal, they're abnormal. There could be discretionary spending, an irregular expense that you never see that just so happened that one year. Maybe one large attorney fee for something that happened in the business that it's never happened before. Those are expenses that are not common in your business. They don't happen every single year, right? And so we can paint that picture to the buyer and say, hey, this large $20,000 fee to an attorney was for a reason and it's never happened. You can't assume that you, Mr. Buyer, are gonna have to spend $20,000 every year on this attorney fee, right? So we can take that and we can add that back to the net profit as well. So we're looking for all of those things. They're called add backs. And this is where things can get a little wishy-washy and in the gray area. And so we just want to really make sure that we can point to the line item expense and we can defend it with a receipt. And so a really good one that I always give an example of is like a personal car, personal truck that you're running through the business and not actually using for the business, right? That can be added back, and it's very easy to add back because we can just pull your car note, we can pull the statement and say, here's how much I pay per month or annually on my personal car that's not used for the business. It's not responsible for generating revenue. Very easy to prove. So we can prove that add back very easily. That almost always gets accepted by banks and by buyers. Another example is if you are pulling a W-2 salary and it's over the fair market value salary for your position in your industry, we can take that difference. If you're paying yourself, $300,000 or $400,000, and maybe the CEO or management role for a business like yours in that industry is $200,000, right? We can take the difference and we can add that back. And then other discretionary expenses like meals, travel, entertainment, it's a very common one. This is when we start getting into the gray area. And the reason why is because if you have a large amount of money being spent on those categories, it's very difficult to prove if that is personal or if it was business or if it was a mix. Yes, you can have receipts, but who was there? And now we're getting into the he said, she said thing, and banks don't like that, buyers don't like that. And so kind of a rule of thumb there is they just take a percentage of those expenses and they'll allow you to add just a percentage of that back. And so the way that can obviously hurt your valuation is because if you have $100,000 in total of meals, travel, and entertainment, and the bank and the buyer will only accept $50,000 of that, well, businesses are bought and sold for a multiple of what they earn. And so it's not just a $50,000 cut, it could be a $150,000 cut, a $200,000 cut, right? And so it just gives you an example of how that starts to affect the valuation or the price of your business. And again, that's why I always just say, if you want to run this exit planning process in the most ideal situation ever, it's to keep personal spending out of the business completely and to show as much profit on your tax returns. And I know that doesn't sound like very appealing to do as the business owner because you're going to pay more in taxes and you can't run the family vacation or some meals and a travel or another trip on the business books. But again, it's going to make the sale process a lot easier, smoother, and you'll be able to defend the higher end of the asking price because the numbers are extremely transparent and they tell the story of the business, right? So those would be the three categories in the business that I would just say keep a close eye on, because those are the gray area categories that are very hard to defend or prove, as opposed to like a personal car or a personal truck. You can pull up your car note, like I said, and you can defend it pretty easily, right? So we take all those things that I just kind of mentioned, the large W-2 salary if you're taking one, meals, travel, entertainment, a personal car, one-time large attorney fee that's never happened before for a one-off event. We can add all that up and we can add that to the net operating income on top of the interest, taxes, depreciation, and amortization, right? So the depreciation, the amortization, the interest, and the tax, we add those to our net operating income. It gives us our EBITDA metric. We can go a little bit step further and we can calculate the adjusted EBITDA number by finding any one-off expenses, irregular spending, discretionary spending, and that will give us our adjusted EBITDA. That's our earnings metric, right? And the SDE is the same thing, right? It's just used more in, like I was saying earlier, owner-operated businesses. And so it essentially is telling the buyer, hey, this owner is heavily involved in the operations of the business, so expect to, yes, get that cash flow, but also work and roll your sleeves up. Not that the EBITDA is saying the otherwise, but that's generally what these two metrics are saying and being used for. So what we do as the business broker, if we're looking at your business, is we're trying to find that adjusted EBITDA for year 1, year 2, year 3, the previous 3 years, right? And we're going to take, this is what we do, and this is, usually what a lot of people do, is we'll take an average. It's more of a conservative approach to take an average of those numbers, those 3 numbers over the past 3 years, average them out, right? So we're literally going to add the earnings number for year 1, year 2, year 3, and then we're going to divide it by 3. That gives us our average, and that is our earnings number in your business. And then we apply a multiple to it, and this is another, topic that is very hot online and just in discussions in this industry, is what industry gets this multiple, what multiple can I sell my business for? It's usually one of the most commonly asked questions that I get all the time. Hey, I own a business in the landscape industry. What multiple are you seeing for that? And my kind of rule of thumb is if you're under $1 million in EBITDA, most likely you're going to expect between a 2 and a 4 multiple. Once you get over that $1 million, you start getting closer to the 4 and over the 4, and it starts to creep up a little bit. It's not a drastic jump up to a 7 or an 8, but it does start to go up once you're over that $1 million. You start to see buyers have a little bit more attraction towards businesses like that. There's more money, there's more cash flow. Obviously, that's more attractive, right? Now, I'll touch on how we figure out, or how we personally will use like a multiplier formula to figure out what multiple we're going to apply to that earnings metric of your business. So we're going to take an average. It's a very conservative approach. You can get a little bit more aggressive. You can go on the low end, but I'm just going to tell you the conservative approach of figuring out the value for your business. So we have our adjusted EBITDA and our EBITDA for all 3 years. We average it out. Now we have that number. And so how I kind of look at multiples is I first take a look at the revenue, right? And so this is somewhat of a formula that banks will use, that buyers will use, and it's almost like a tiered system. So if it's under $1 million, you get 1.25 multiple points, right? 1 million to 5 million, you get 1.5, right? This isn't a set in stone formula. It's used industry wide, but it's a very good way of figuring out what multiple can be used. So basically a tiered system on revenue, a tiered system on EBITDA, and then we start to look at other things in your business, and I just wrote them down here and I'll go over it. So, let's say you're doing, $5 to $10 million in revenue. Let's start with 1.75, right? So we're just gonna start totaling things up and see how high or how low this multiple will be. Let's say the EBITDA is $500K to $1 million, there's another 1.75, right? And then we start to look at non-financial type of variables. And I'm just plugging this in. So now we look at non-financial type of variables. So we're going to look at things like Is the owner absent from the business, or is the business really dependent on the owner? Is it a high growth industry? Has this business been in business for more than 10 years? And then some negative things that will chip away at the multiple is the business under 3 years old? Is it decreasing revenue? Is it dependent on the owner? Different variables like that. And these are more so telling you, is the business sellable, right? And is it transferable? Can we transfer this business over to another buyer? And these numbers are going to stay somewhat consistent. And so when you plug away at different things like that, you can see how it can change your multiple a little bit. But let's just say the business is owner absent, it's increasing revenue, it's in a high growth industry. So we add those boxes together, and it gives us a 4 multiple. It's just a formula that I use on my end. Again, this is not like a set in stone industry standard type of thing. It's just what I use on my end. And so we would apply a 4 multiple to a business like that based off what I said. $5 to $10 million in revenue, $500K to $1 million in EBITDA. The owner is absent, it's increasing revenue, and it's in a high growth industry, right? And so that gives us a 4 multiple on your earnings. And so again, taking the average of the last 3 years, applying a multiple to it, giving us our asking price on the business. And that is something that then I would look at and see if we can get a little bit more aggressive, or if we need to stick at that price. But this kind of leads me into the next one of how do you position your business for the highest possible price? And those last variables that I talked about, the owner dependency, increasing revenue, high growth industry, those are very important. But buyers are going to look at your numbers first. As I was saying in the beginning, it's the core, it's the nucleus of every deal, of every business sale. And that will help us determine what the price of your business is, like I just went over, right? You can do some back of the napkin numbers right now on your own business and get some sort of range of where your business can sell for. Call it $5 million, right? You just figured out your adjusted EBITDA for the past 3 years. You averaged it out. You applied a multiple of 4 or 3.5 or 3, and that gives you your range for what you could ask for your business if you wanted to sell it. But that doesn't tell you if your business is sellable, right? Just because we can put a price tag on the business, it doesn't mean someone's going to want to buy the business. And this is, I would say, probably more important than really your numbers. I mean, or equally important, right? And so the most common things that prevent businesses from being sold, when an owner is actively trying to sell their business, they're trying to exit and they can't, even if they have help from brokers, they can't get it sold. There's no interest in the business. A lot of the main reasons for that happening is, one, the numbers, the financials just aren't attractive. It's not making money, or it's declining. There's something wrong in those financials. But then outside of the financials, probably in my experience, without a doubt, it's owner dependency. The business is too dependent on the owner or the ownership. I know a lot of business owners take a ton of pride in how much they work and how involved they are in the business, and it is amazing, but it is also the leading thing that's going to prevent you from selling your business. If I wanted to buy your business and I pull you out of the equation, what's going to happen to the business? Or if you go take a month-long vacation, a 2-month-long vacation, you can't call employees, you can't do anything, you can't call customers, what happens to the business? What happens to revenue? What happens to the employees? What happens to the customers of your business? Do things start to slowly fall apart? That is very concerning for a buyer. And so you want to get yourself out of operations as much as you possibly can, out of being a key dependency or a key employer, I guess I should say a key personnel problem in your business. That is probably by far one of the most concerning issues for buyers, and one of the top reasons why businesses do not sell is too dependent on ownership. Whether it's relationships with big customers, whether it's you're out on job sites or whatever it is, whatever the reason may be, you have to get yourself out of that position of the business being dependent on you. If that's high, and again, I know it's very easy for me to sit on this side of the screen and say that, and it might take time to implement, but it's definitely worth implementing, especially if you're looking at it 3 years to sell your business, 5 years. If you have time to start looking at that and implementing that, whether it's delegating more tasks and responsibilities to key employees already there inside the business, or hiring from outside and bringing them in, it could single-handedly be the reason if your business doesn't sell or not. And that's just being truthful. I've definitely seen that before. The owner dependency preventing the business from selling. And what typically happens is the buyer asks the owner to stick around for a decent amount of time, 12 months plus, right? Signing some sort of consulting agreement or employment agreement. That is most likely the route you'd have to take if you wanted to sell, is to sell and then continue working there for some sort of salary or consulting salary under the new buyer. So you become an employee of your business, and you would essentially have to do that because it's so dependent on you being there. So definitely get yourself out of the business having to be dependent on you. Another big thing is again, and I'm just covering items that prevent businesses from selling. And so this is the second thing I wanted to cover, was how can we best position the business to sell for the highest possible price? That would be the first thing, is get out of the business being dependent on you. Another really important thing is to look at is customer concentration, which I talk about this a lot. And really all that means is how spread out is your revenue. It gives a lot of comfort to a buyer if it's diversified across a bunch of different clients or different industries. And ideally, again, the rule of thumb is you don't want any one customer of yours or any one client of yours to be responsible for more than 25% of the total company revenue. So if you have one large customer that you've been working with for 10 plus years and they're super loyal and they'll never go anywhere, they're not under contract, but they're never going to go anywhere according to you, and they bring in about 45% of the total revenue that you do at your business, it starts becoming a little concerning to the buyer. Because if I buy the business and that customer that's been super loyal to you, or the business as you say, right, and they leave and they say, sorry, I just had a really good relationship with the past seller, I knew them from college or high school or whatever, we built a good strong relationship, and that was the reason that we did business together, and I'm going to go somewhere else now, I immediately lose all of that revenue overnight. And that is a big red flag. It's very concerning. And so you want your revenue to be spread out, and you don't want your top customer, if you can go into your QuickBooks or pull any of your reporting metrics and figure out how much revenue is our number one customer bringing in for our business. And if it's more than 25%, you got to do everything in your power to get that below 25%. Again, I wouldn't say that one is as much of a deal breaker, but the higher that percentage gets, the more it becomes a deal breaker. And I have definitely seen businesses not sell for that reason, without a doubt. For that being the only reason, the only concern from a buyer was that there was a large customer that was responsible for a lot of revenue in the business. It was upwards of 40%, so that was pretty high. So you definitely want to diversify that revenue, right? So those would be the two big things. Clean books, kind of what I touched on in the first one about the meals, travel, entertainment. Again, I just want to keep saying this, but the most ideal situation ever, as a business broker, if a business came to me, these things would all be in order and lined up. So the clean books would be another one, and just no personal spending in the business, right? Clean books, clean tax returns, showing high profit on the tax returns, year over year over year growth for the last 3 years. So as far as numbers, that's really what I'm looking for. Just, you want to see stable consistency with obvious growth, right? That is the best situation possible. And then another thing that does help is how long have you been in business for, right? I've had calls with people who have been in business for 2 years and they want to sell, or in 3 years and they want to sell. And it's a different situation than someone who's been around for 15 years, 20 years. It's a different sample size, right? And there's the business that's been around for 15, 20 years, well, they've been around the ups and downs in the market, the ups and downs in the economy, right? The different presidents that have been in, like, they've been able to withstand whatever was going on in the world, in the economy, in their industry, in their market, and they're still standing and they're still pumping out good numbers. That is very reassuring, and it's very attractive to buyers to look at a business that's been established for that long. Not saying being in business for 3 years is bad. I'm just saying the more you're in business, the longer you're in business, I should say, 10 plus years typically, brings a lot more attention to your business when you pass that threshold. Again, not a requirement at all. We've sold businesses at 4 years old, 6 years old, 7 years old, and then obviously a few over 15 years, but we've sold businesses under 10 years all the time. It happens all the time. Again, I'm just showing you the most ideal situation possible. And then kind of going into who is going to buy my business. And actually, just to back up real quick, another thing that I would say, if you want to make your business as attractive as possible and to drive as much attention is, and this probably doesn't apply to all industries, but if you can get some sort of reoccurring revenue or subscriptions, it doesn't have to be a ton, but anything you can get secured under a contract or a long-term contract, it does give some reassurance to the buyer, because then you can essentially say, hey, 20% of our revenue is under contract, or it's recurring revenue signed up through subscriptions or some sort of maintenance that we do for our customers. Again, not a requirement. We're just going over the most ideal situation to squeeze the rag dry and get as much money as you possibly can for your business. And so if there's something that you can implement, if you're in the home services and you can do some sort of maintenance contract, it's very attractive for buyers to see that a lot of this revenue is secured for them, so they can step in and they know at least, hey, I got 20% of this coming in for me without a doubt. The business isn't dependent on this owner leaving, so once they leave, these numbers are not going to fall through the floor. Everything's going to be fine. They've been around for 10 plus years, so we know they've been through the ups and the downs. That is what brings in a lot of buyers to take a look at your business. And then speaking of buyers, to touch on kind of the last thing is, who's going to buy my business? And I don't know what industry your business is in, if you're watching this, but I will say there's a buyer out there for every business, as long as you have those fundamentals implemented in your business, the ones I just discussed. If you've gotten yourself out of operations, the business isn't dependent on you, you have clean books, you've shown year-over-year growth, you've been in business for a little bit, it's not all the revenue coming from one big customer, you've got a little bit scared under contract or a maintenance recurring revenue contract. If you can have a few of these pillars and these fundamentals in your business, there's going to be a buyer for that business in any industry, most likely. And so who those buyers typically are, and in this space, they label them as two different types of buyers. They label them as strategic buyers and financial buyers. A strategic buyer is essentially another business that is looking to buy your business or another business to expand geographically, to add services to their business that they might not have. Maybe it's for acquiring labor that your business has that they don't. And so they're a business that's looking to buy another business for a strategic reason. They see value in adding your business to theirs, merging them together, or rolling them up, or bolting them on, whatever you want to call it. That would be a strategic buyer. As you can imagine, as you start to think about your own business, that could be, a manufacturer to your business, or even a competitor down the road that wants to break into that area of the state that you're in. It could be for a variety of reasons. Sometimes strategic buyers see more value in your business than the other category I'm going to cover, which is financial buyers, because there's an immediate plug-in, right? They immediately can add your business to theirs, and all of a sudden things are rolling. They have an additional service that they've got a whole back-end team that can plug and play immediately. And so at times it can be a good match where they see more value than a financial buyer might, and the result of that could be a higher purchase price on the business. Not always the case, but there could be if the stars align. I've definitely seen that happen. And then the second type of buyer would be the financial type of buyer, which would probably be, I would say, 70 to 90% of the buyers that are going to inquire on your business are going to be in this financial buyer category. It could be an individual corporate professional who's made money their whole lives, but they want to get out of the 9 to 5. They want to go bet on themselves and buy a business. It's very, very common. You're starting to see a lot more of that now over the recent, 3 to 5 years. The entrepreneur out there that's made some money that wants to get into business themselves. They're teaching programs at colleges now called entrepreneurship through acquisition, basically teaching college kids on how to find businesses and acquire businesses, and instead of starting a business, just buy one and then start from there. And then, of course, you've always had the investment groups, the private equities, the micro private equities, the family offices. So they've always been around. They've always been out there looking to buy businesses. So we do have a lot of buyers, converging into the market right now of buying businesses. But I would imagine most industries are going to see majority of buyers that inquire, that are interested, they want to look and sign that NDA to look at your business, are going to be the financial buyers, just because there's more of them, right? And so again, depends on your industry, on what that breakdown would look like. But those are the two buyers. And again, any business in any industry, there's a buyer out there for it. What these buyers are looking for at the end of the day, this is an investment for them, right? So they're looking for a return on what they're putting down to buy the business. And so at times it's not so much the industry. I mean, maybe the strategic buyers are obviously looking for specific industries, but these financial buyers, they're looking for a return, right? Or they want to go bet on themselves, and the industry isn't that big of a deal to them. Maybe they have some managerial experience and they're looking for a business where the owner isn't involved in operations. Again, this is why I say don't make the business dependent on you, because the less it's dependent on you, the more it opens up your buyer pool, the more people come to the table, the higher the offers get, the bidding war starts to happen, right? And so if you have someone coming from the corporate world, they've worked there their whole lives, they've been making six figures their whole lives, they've saved up the money, the 401k, they have the money to buy the business, they've led teams before, they're a good person, they're a family person, and they want to go bet on themselves and they want to go buy a business, but they don't have direct experience in the industry that you're in, but they know how to run the team, they've managed a team before, right? They've been in whatever department at their business, and they've succeeded, and they have a track record of succeeding, but they don't have direct experience on your business or in your industry. But it also might not matter as much now, because you've removed yourself so much from your business that they're able to step into your shoes, manage the team, and start bringing different ideas to the business and continue its growth, right? So again, that's why I always just harp on those two things of the business being dependent on you and the customer concentration, is because the more you can get these different variables that I discussed earlier in place on your business, the more buyers are going to want to buy your business. And the larger your buyer pool is, the deeper your buyer pool is with strategic buyers, with financial buyers, the more offers you're going to get. And then you can start to, what my job is then, is to start pinning these offers against each other. And there's been several times where we've gotten an offer signed higher than what we were asking for on the business for this exact reason, because these people just want to get out of corporate, or they want to add to their portfolio, or they just want to be a business owner and they have the money and they're ready to do it. And this is a perfect fit because it's not dependent on the owner. They've been around for 10 plus years. They're showing year over year growth for the last 3 years. The customer concentration is below 25%. They've got reoccurring revenue. I know as a buyer that when I buy this year one, this revenue is pretty stable. It's pretty predictable. And we can transfer this business over to me without a lot of hiccups, because it's not dependent on the owner, and it's a pretty seamless, smooth business that they've documented their processes and their SOPs. And it really makes a buyer secure and confident in proceeding and moving forward with actually buying the business when you have all of those in place. And again, I'll just say it one more time. It brings more buyers to the table for your business when you have that. If you don't have that, it just shrinks your buyer pool and becomes more difficult to sell your business and more difficult to get the asking price on your business. And so this video was about how can we squeeze the rag dry and get the highest possible amount of money for your business when you want to sell it. And that is exactly what I would tell you to do and what I would look for in your business if you were trying to sell it at some point. And so if you have time to put those things in place, I would definitely focus on that. And again, I wouldn't say those are deal breakers, because we've sold businesses with none of those things in place before. And it's doable. You just probably aren't going to get your full asking price on the business. And so I want you to get that. And so that's why I wanted to make this video. If you have any questions on anything I mentioned here or anything at all about your business, about selling your business, feel free to reach out to me or comment on this video, and I'm more than happy to answer those. But I appreciate you watching. My name is Jordan Kelleher. I'm the founder of Kelleher Acquisitions. We help business owners like yourself sell their business.